The Best Guide to Infinite Banking by Infinite Banking Simplified. The authors are Isis B. Palicio, LUTCF MBA, and Pedro A. Palicio, MBA and PhD. Slide 2. The Banking Business. It's important for you to read Becoming Your Own Banker by Nelson Nash. And let me talk about Nelson Nash. He said, banking is the most important business in the world. Without it, all business comes to a screeching halt. Whenever a business transaction takes place, money must flow from one party to another in a relatively short time, or otherwise nothing takes place. That flow of money must come from a supply source, a reservoir. That is the essence of what the banking business is all about. Someone or some organization has control of a pool of money that can and must flow at a cost to meet some need. Money flows from the pool through our hands to meet our needs, but somewhere in the process, it all ends up back in the banking system. It is all a matter of how much of the banking function do you control as it relates to your needs. This book is all about how to create your own banking system so that you can control 100% of your needs, becoming your own banker. Give it your close attention, and it can make a radical improvement in your financial future. That's page 11 on Nelson Nash's Becoming Your Own Banker. Then in page 52, he says, everyone should be in two businesses. The one in which you make your living, and the other should be the banking business that finances whatever you do for a living. Of the two businesses, banking is the most important. Businesses come and go, but banking is eternal. That's page 52 on Nelson Nash's Becoming Your Own Banker. Slide 3, the banking business continue. There's only one pool of money in the world. That pool of money is managed by banks, insurance companies, brokerage firms, individuals, and other financial institutions. Money flows from the pool through our hands to meet our needs, but somewhere in the process, it all ends up back in the banking system. We can create our own banking system so we can finance 100% of our needs. There is a saying by Will Rogers that is, the problem in America isn't so much what people don't know. The problem is what people think they know that just ain't so. Slide 4. The banking business continue. As you can see, you can create your own IBC, Infinite Banking Concept System, using a life insurance, as we will describe in other slides. And there is a Chinese proverb that says the best time to plant a tree was 20 years ago. The second best time is now. The banking business continue, leveraging cash flow from other people's money. Let's see how banks make money. The important thing is they use money from somebody else, not their own money, and they leverage that money to make business and to make a tremendous return on investment. This is a typical example. You are an individual that deposits your money in the bank, and the bank pays you a saving interest of 4%. The bank have all the money from all the depositors, and what do? They lend that money to people that want to purchase a home, and they charge them 7% annual interest. They get money, and they lend that money to people that want to purchase a car, and they charge them 9% annual interest. And they have other individuals that have credit card, and they're charged about 20% of annual interest. So they make a tremendous amount of profit. Why is that? They don't use their money. They use the money from the depositor to lend that money to another people, making a tremendous return on investment. In the case of the home, they make 75%. In the case of lending to a car purchaser, 125%. And in credit card, is a return on investment of 400%. These could be your profits if you implement the infinite banking concept. Slide 6, creating your own banking system. The very first principle that must be understood is that you finance everything that you buy. You either pay interest to someone else or you give up interest that you could have earned otherwise. The alternate use of money must always be reckoned with. Some call this opportunity cost. This is page 21 of Nelson Nash's Becoming Your Own Banker. There are three different types of individuals. One is the borrower. This individual pay interest to someone else. As you can see the timeline here, 0. That individual need to purchase, let's say, a car. What does he do? He goes to the bank or the car financing company. He borrows the money and he starts repaying his loan. He goes back to 0. By the time he goes to 0, he might need a second car. He does over and over again the same thing. So this individual is always in debt. He's the borrower. Pay interest to someone else all the time. The second type of individual is called the saver. That saver, what he does, he save cash someplace. Let's say it might be in a CD in the bank. But when he needs to purchase a car, he take all that money, purchase the car, and goes back to 0. He starts saving again for the next time he need the second car, etc., etc. So this individual, although he or she earned interest in this portion of the process, when he goes back to 0, he gives up interest and interrupt compounding. And that's key. In order to keep your wealth, you have to keep compounding all the time. And how do you get that? So an IBC policy, who we'll describe later. Here is called the wealth creator, uninterrupted compounding. This individual, the green line, is the cash value of an infinite banking policy. What does he or she does? He take a loan against the cash value. Meanwhile, the cash value in the policy remains in his policy, earning interest and dividend, because the cash value doesn't come from his policy, come from the general account of the insurance company. So individual is a wealth creator. Recognize that controlling the banking function personally is the most important thing that can be done in your financial world. Slide 7. Infinite banking concept, process, and platform. There are two components. The first one is the process. IBC is not about life insurance. That's important to recognize. Indeed, it is not about a financial product at all. Rather, Nelson Nash is trying to change the way people think about their financial decisions. Too many Americans follow the gurus when they tell them to put a small sliver of their paycheck into a highly restricted stock market investment program, also known as tax qualified plans, quote unquote. So they cannot touch these quote unquote savings until decades later when they retire. In the meantime, when these people need to spend money on big ticket items, they are counseled to do what everybody does: go to outside lenders. The result is that the typical American is swimming in debt, with a large fraction of his monthly income devoted to paying interest to outsiders. The fundamental change in thinking occurs when people flip this arrangement. This is important, so pay attention here. Rather than giving away your savings to the control of outsiders, so that we must approach outsiders hand in hand whenever our expenses exceed our paycheck, we can begin instead to capitalize your own bank. That is, we direct as much cash flow as possible into building up an asset that we control. IBC is indeed an exceptional cash flow management strategy for your personal economy or for your business. Now, the other aspect, we talk about process, let's talk about platform. You could use different alternatives. For example, home equity line of credit or HELOC, but the value of your home may go down and the bank change the rules. You might use also a margin loan from brokerage accounts, mutual funds, stocks, or bond, but with margin loans, there's a lot of parameters involved that can cause havoc if things don't go well. You could use universal life insurance policies, including equity, index, and variable, but the insurance companies transfer some of the risk to the policy owner. It just so happened that when we survey the world as it is, a dividend-paying whole life insurance policy is by far the best platform in which to implement IBC. It is a guaranteed method of building wealth, and contractually obtain access to cash values via policy loans. Let's go to slide 8. Mechanics of a dividend-paying whole life insurance policy. A dividend-paying whole life insurance policy is a permanent life insurance policy. This type of policy have two elements, the cash value and the death benefit. The cash value is the present actuarially discounted value of the death benefit, or in simple English, your equity in the policy. It represents what is called your living benefits. An important notice I want to make clear here: when you die, your beneficiary get paid only your death benefit, not the death benefit plus the cash value. There are three mechanical components in an infinite banking concept whole life insurance policy: a base whole life policy, a term rider, and a paid-up additions rider. The term rider is usually a 1-year term insurance rider that every year converts a portion of itself to whole life insurance to achieve the desired target death benefit. The paid-up additions rider create mini paid-up whole life policies that attach themselves to the base whole life policy. All these mini policies generate dividends, and the process repeats itself, and therefore the cash value as well as the total death benefit keep growing exponentially. Notice that these mini policies require just one single premium payment, and they are forever paid up. There are two types of paid-up additions rider: a scheduled and unscheduled paid-up additions rider. We'll see a graphical representation of policy designs in page 10. Page 9, design of high cash value infinite banking policies. Assume an individual wants a high cash value IBC policy where he or she contributes X dollars in annual premium for so many years. Depending on the individual's gender, age, health status, and lifestyle, we need a target death benefit of at least Y dollars to avoid the IBC policy from becoming a modified endowment contract, or MEC, and losing its tax-free distribution advantages. The first step in the design is the base whole life policy. But if we allow this base whole life policy to have the required Y dollars of target death benefit, it means that most, if not all, of the X dollars in annual premium will go towards the cost of the base whole life policy, and the IBC policy would not be very efficient in generating cash values. The next step is to reduce the death benefit of the base whole life policy to 10% to 25% of the X dollars in annual premium would purchase, and use a much more economical 1-year term insurance rider in such a way that the death benefit of the base whole life policy plus the death benefit of the 1-year term insurance rider is originally equal to the target death benefit of Y dollars. The difference between the X dollars in annual premium and the cost of the base whole life policy plus the cost of the 1-year term insurance rider, which is approximately 75% to 90% of the X dollars in annual premium, is used to purchase paid-up additions, PUAs, through the paid-up additions rider. As the death benefit of the PUAs increases, the death benefit of the 1-year term insurance rider decreases until this rider disappears, and the total whole life death benefit grows beyond the target death benefit of Y dollars. This design generates the highest cash value for a given annual premium paid for so many years. Note, this slide, we realize, may appear complex to the newcomer, but it is the general approach taught by the Nelson Nash Institute and is adapted to your specific financial situation. We'll see a graphical representation of policy designs in page 10. Graphical representation of graphical design. If the insurer is a male, age 35, with the best rating, paying premium of $25,000 a year for 15 years. We have three scenarios. The first one is a traditional whole life, in which 100% of the premium goes toward the base whole life policy. The second one is a combination of 40% base policy and 60% paid-up addition. So 40% consists of the whole life policy and 60% PUA. And the third one is 10% to the base policy whole life and the remainder to the paid-up addition rider. As you can see here, we have the end of policy year between year 1 and year 60 and the cash value of all these three scenarios. Let's take as an example the end of policy year 10. In the first scenario, the cash value at the end of policy year 10 is $240,000. In the scenario 2, the cash value is $281,000 plus. In the scenario 3, the end of the year policy cash value $297,000 plus. As you can see, the cash value increases going from left to right. So the design that maximizes the cash value is the one that maximizes the paid-up addition rider. Slide 11, capitalization period and cash value. Capitalization period or cumulative break-even year refers to the policy year when your cash value equals or exceeds the total premium paid to the policy. It is the year that your IBC policy becomes profitable, and the profitability of your policy is contractually guaranteed to increase every year. Remember, any type of investment that you make, either real estate, starting a professional practice, or getting a college degree, has a capitalization period of several years after which you are increasingly profitable. The cumulative break-even ranges from 4 to 8 years in most cases. Now, the annual break-even refers to the policy year when the cash value generated in that year equals or exceeds the premium paid to the policy in that year. The annual break-even ranges from 2 to 4 years in most cases. Once you pass the annual break-even, you have a financial asset that generates more contractually guaranteed cash values every year than your annual premium contributions in that year. That being the case, wouldn't you want to contribute as much as you possibly can to that asset? Although not guaranteed, your IBC policy may receive annual dividends. The insurance companies that we use have paid dividends every year for over 170 years, including the Great Depression and 2 world wars. The dividends are typically used to purchase paid-up additions and therefore will increase your cash value in the most efficient way possible. Note on liquidity. You don't have to be fully capitalized to access your cash value. You can take a policy loan of 95% to 99% of your cash value as soon as your first premium payment has cleared your bank and the life insurance company's bank. Slide 12, increasing the efficiency of your IBC policy. The efficiency of your IBC policy is measured by how fast and how much you can increase its cash value. Notice that when credited to your policy, all cash value increases and any dividends you receive are locked in, unlike stock and real estate market gains. One way to increase the cash value of your IBC policy is to identify those annual payments that you must make to an outside source, like taxes to the IRS or your mortgage payment to the mortgage lender. You then contribute the total of this amount to your own schedule, paid-up addition rider. Then at the end of the year, you take policy loans to make those payments to the outside sources. From the following year on, you start making payment to your policy loan to replenish its value, and you repeat the process every year. This makes your policy substantially grow your cash value and make it more efficient. Another way to increase the cash value of your IBC policy is to direct any extra discretionary income like bonuses, windfalls, etc., to the unscheduled paid-up addition rider within MEC limitation. Now, a lot of people ask us, can you make your IBC policy infinitely more efficient? The answer is no. As you increase your contribution to the unscheduled paid-up addition rider, you will get to a point where you have maximized the cash value efficiency of your IBC policy, and further contribution to this rider will make your policy to become a modified endowment contract or MEC. When you reach this point, you have indeed maximized the cash value efficiency of your IBC policy, and it is time to start your next IBC policy. Line 13, cash, who has it? Cash value permanent life insurance is the #1 asset for Tier 1 capital in conventional banks worldwide. In fact, bank-owned life insurance or body in huge amounts in their financial portfolios. The numbers below represent how much cash value these banks have from their life insurance policies of last year. As you can see, Bank of America, 24 billion. Wells Fargo, 19 billion. JP Morgan Chase, 12 billion. PNC Bank, 10 billion. Truist Bank, 7 billion. Banks understand the economic value, high cash value, permanent life insurance as a golden asset. Do you understand it? Slide 14. We have an excellent book here, Cash Flow Quadrant by Robert Kiyosaki. And he believed that people belong either of 4 cash flow quadrants. One of them is the employee, in which you have a job. The next one down is the self-employed, where you own a job. The third one, the top right-hand side, is the business owner. You own a system and people work for you. And the last one is the investor. You own investments and money work for you. Now, something interesting that Robert Kiyosaki mentioned is the main reason people struggle financially is because they have spent years in school but learned nothing about money. The result is that people learn to work for money, but never learn to have money work for them. It's very important quotation here. Now, which cash flow quadrant are you in? Regardless where you are, implementing IBC will help you in all 4 cash flow quadrants and improve your chances of becoming a business owner or an investor. In Line 15, IBC policy and policy loans. Here is where the magic happens. As you can see here, you have a policy owner. You have an IBC policy in which the cash value grows at net 4 or 5% annually, and you pay premium, the policy owner pay premium to the policy. Here separate, you have the life insurance company. When you take a loan, you take the loan from the insurance company and you repay the loan to the insurance company, and any excess interest in repayment they go to unscheduled paid up addition rider. It is very important that you read the following. Your premiums earn interest and dividend currently at a net annual rate of 4 to 5%. When you take a policy loan, the money comes from the insurance company's general account and is collateralized by your cash value. Your full cash value remains in your policy, earning guaranteed interest and dividends. The insurance company charges fixed interest of about 3% to 5% on outstanding loan balances. However, your IBC policy's cash value is continuously increasing due to interest and dividend, and it may outgrow loan costs depending on when you take the loan. This is very important chart. I recommend that you read carefully and understand all the issues or ask us questions. Slide 16, the ins and outs of policy loans. Where does the loan money come from? When you take a policy loan, the money, as I mentioned before, does not come from the cash value of your IBC policy, but from the general account of the insurance company, while your cash value remains in your policy, earning guaranteed interest and dividends. Like the banking business, you leverage cash flow from other people's money, and that's the money from the insurance company. It's not your money. The amount your loan is collateralized by the same amount of cash value in your policy, and as you pay down your loan, the exact amount of cash value is released from collateralization, and it again available to for another policy loan. Now, people ask us, do you have access and control your money? Absolutely. You have cash value in your policy. You have a contractual right to policy loans. The policy owner always has the first right of refusal to borrow against the equity in the policy and cannot be turned down for a loan. How much money do you have available for a policy loan? The maximum policy loan available is about 95 to 99% of the unencumbered. It means not collateralizing any loan, cash value, your IBC policy. How fast can you take a policy loan? You can take a policy loan as soon as the cash value collateralizing the loan has cleared your bank and the life insurance company bank. How about loan interest payment? The insurance company charge you loan interest from the day you take the loan until your policy anniversary date, which is the date of the year when your policy was issued. The interest charge is simple interest. If the loan interest is not paid when due, it is added to the loan amount. Slide 17, the in and out policy loan continue. What is the danger of taking the maximum amount of available loan? Since the loan interest needs to be paid no later than your anniversary date, you may not have enough cash value in your policy at that time to pay for it, in which case you will have to pay it with out-of-pocket money. We recommend that you think about it before taking the maximum amount of loan available. What is the best way to increase the amount of available loan? The best way is to increase the cash value of your IBC policy, and you accomplish this by making as large as possible contribution to your unscheduled paid-up addition rider within MEC limitation. The next question is one that we get asked a lot. When should you take a policy loan and when should you pay for cash? You should take a policy loan if the expenditure you have in mind is a lifestyle necessity, a reduction of debt, or an investment. Lifestyle necessities can be repairs, maintenance, and replacement costs of facilities and infrastructure that serve to increase your future production and or future revenue. Debt reductions serve to increase your net worth. Investment appreciate and then can be sold for a profit. All three of those types of expenditure contribute to building your estate in the long run and are appropriate expenditure for taking a policy loan. On the other hand, living expenses such as food, gasoline, utilities, and similar consumption costs are completely different type of expenditure that should be paid for with cash, not policy loans. You don't want to use your IBC policy like an ATM every month. Slide 18, the ins and out policy loan continue. Now, what happens when you repay a policy loan? An amount identical to your loan repayment releases cash value from collateralization and make it available for another loan. The next question is important. Do you understand that you should pay the policy loan interest every year, except you are using policy loan to supplement your retirement income? You should pay the policy loan interest every year because otherwise it is added to the policy loan principal. And if you are not careful, it may grow out of control. If you are using policy loans to supplement your retirement income, we don't recommend that you pay the loan interest every year, but you should carefully monitor the growth of your outstanding loan balance. A question we get a lot of times is, should you take withdrawal or policy loan when you are supplementing your retirement income from your IBC policy? The most financially efficient way to legally avoid paying income taxes is to start by taking withdrawal from your IBC policy down to your cost basis, which means the total premium you have paid to your policy, and then switch to policy loans. Comparing cash value growth and loan interest cost in large policy loans. If a large policy loan takes place during the first 6 years or so of the policy, the cumulative loan interest cost will probably be larger than the cumulative cash value growth. If the large policy loan takes place later than the 6 or so policy year, the cumulative cash value growth will probably be larger than the cumulative loan interest cost. Now, what happens if you die with an outstanding policy loan? The life insurance policy deducts the outstanding policy loan from the death benefit going to your beneficiaries. Slide 19, direct and non-direct recognition insurance contract. A non-direct recognition insurance contract does not adjust the dividends paid on a policy when there is an outstanding policy loan. A direct recognition insurance contract adjusts positively or negatively the dividends paid on the portion of the cash value collateralizing policy loan. In reality, the loan cash value have a dividend rate that is a certain number of basis points below the loan interest rate. If the loan interest rate is high, this can cause the loan cash value to earn higher dividend rate than the non-loan cash value. If the loan interest rate is low, then the loan cash value might earn a lower dividend rate than the non-loan cash values. As an example, currently, Guardian Life has a dividend rate on non-loan cash value of 5.90%. Its loan interest rate is 5%, and the loan cash values have a dividend rate that is 50 basis points lower, or 4.50%. We want to emphasize this. What is important to you as a consumer is what the insurance contract will provide you in cash values at points in time that are of relevance to you. In fact, dividend recognition is not the most important factor when selecting the best insurance contract for your needs. Premium flexibility of IBC. This is slide 20. IBC policies offer you a tremendous flexibility in the payment of premiums in the case you cannot pay them with out-of-pocket money as originally planned. One is the automatic premium loan option. It allows your policy to pay for the base whole life policy premium through a policy loan, assuming you have enough cash value in your policy. It is an emergency option. The second one is the premium offset option. Allows you to stop out-of-pocket premium payment when you strongly believe that the policy is self-sustaining. The dividends and interest of your policy are used to pay the base whole life policy premium, and the remainder goes to cash value. There will not be a sudden drop in death benefit. There will be a slight drag in cash value performance. This option is reversible, and it would allow you to continue to make out-of-pocket premium payment in the future. You should request in-force illustration often to be sure that the policy remains self-sustaining. The last is the reduced paid-up option. It's used when you don't wish or cannot pay your policy premium without pocket money ever again. This option should not be exercised before policy year 8. The dividend and interest on your policy are directed to the cash value. There will not be a drag in cash value performance, but there will be a drop in death benefit. This option does not allow you to pay premium to the base whole life policy or the paid-up addition rider ever again. This option is irreversible. You should have full certainty that is what you wish to accomplish before exercising this option. Slide 21. Investing versus banking with an IBC policy. Investing. The definition is intentionally separating your control of the money with the expectation that additional money will be received in the future. Banking with an IBC policy. Intentionally keeping your flow of money permanently in an environment where you have complete control and accessibility. An IBC policy is not an investment. Nevertheless, investing and banking with an IBC policy works hand in hand, since an IBC policy can enhance investments. Notice the following. Once you have your IBC policy established, it means past the capitalization phase, you always get a higher rate of return in any investment you might make by taking a loan from your IBC policy than paying for it out of your pocket. Using your IBC policy will always increase your return on investment. Slide 22. Benefits of an IBC policy. The first one is guarantees. You have guaranteed cash value increases. This benefit Guarantee level premiums will never go up. Slide 23, benefit of an IBC policy. The second one is uninterrupted compounding. Compounding is slow and boring during the first 6 years or so, and then it becomes downright fascinating. Cash values have uninterrupted compounding. They increase by larger amounts every year. Not only they increase, but the increase is larger every year, as you can see in the slide here. Slide 24, benefit of an IBC policy. The third one is liquidity. Liquidity provides you protection in case of emergencies. As an example, might be a roof replacement, medical expenses. Liquidity provides you leverage opportunities for investment and in cases of black swan events. As an example, investing and expanding your business or professional practice, private lending, private equity investments, franchises, mortgage and tax liens, and investment in real estate and other businesses during and immediately after an economic depression. Slide 25, benefit of life IBC policy. The first one is flexible loan provision. It provides you contractually guaranteed line of credit. It provides you unstructured loans. You can take out how much you want, subject to cash value availability, when you want it, and pay back on your schedule. It provides you ultimate control, no tax consequences on loans, no explanation of loan purposes, no loan repayment schedules, no required minimum distribution, no rules or restriction on usage, age, contribution limits, withdrawals, or taxable events. Slide 26, benefit of an IBC policy continue. Number 5 is privacy. Different from traditional banks or financial institutions, an IBC policy offers you total and absolute privacy. An IBC policy is a private contract between the policy owner and the life insurance company, and it is not in the public domain. It also protects your wealth from creditors, judgment, and lawsuits in most states. The cash value and the death benefit of a permanent life insurance policy is not available to creditors, judgment, and lawsuits in most states. Slide 27, benefit of an IBC policy continue. The sixth one is continuous cash value growth. As mentioned before, you have guaranteed cash value growth, and that increases your wealth. Slide 28, benefit of an IBC policy continue. The 7-1 income tax-free transfer of wealth. The death benefit of an IBC policy create a legacy and offer protection to your loved ones. You can purchase a small IBC policy for your minor children so they can learn about how money works at an early age. As an example, at the present, the national debt is $34 trillion. The insurance industry death benefit is $28 trillion. An interesting caption is here: life insurance increases the stability of the business world, raises its moral tone, and puts a premium upon those habits of thrift and saving, which are so essential to the welfare of the people as a body. That from Theodore Roosevelt, U.S. President. Slide 29, benefit of an IBC policy continue. The age one in high savings yield, consistent and predictable savings environment. It gives you certainty for your whole life. Slide 30, IBC policy compared to others investment. As you can see here at the top, you have different IBC policy compared to other different investments that you can make, like an IRA, a 401k, mutual fund, bank savings, CDs, annuities, real estate, and your home. On the left-hand side, you have different characteristics of different products, like guarantees, risk-free, penalty-free, tax-free, liquidity, use and control, tax deferred, protected from creditors, leverage, tax-free transfer, collateral, and disability benefits. To analyze any cell here, for example, if it is green, it means that this investment or IBC policy have this characteristic. For example, bank savings and CD, are they risk-free? The answer is yes, so it's in green. If the cell is in red, it means that no, they don't have that characteristic. For example, bank savings, penalty-free? No. Bank saving or CD, you withdraw the money before it's time, you might have a penalty there. So cells in green means that you have that ability, that characteristic. In red means you don't have that characteristic. And in yellow, it's possible that you have. It depends on the situation. So if I were you, I would stop this presentation right here and analyze your IBC policy against any other kind of investment that you have in mind to see the characteristics they have compared to your IBC policy. Slide 31, creating sustainable wealth without risk. Successful implementation of IBC requires, pay attention to this because that's very important, requires patience, discipline, and long-range planning, as IBC is not a get-rich-quick scheme, and it is not for the person who is always looking for instant gratification. By all means, espouse an abundance mindset and avoid a scarcity mindset. We recommend strongly to read Becoming Your Own Banker several times with an open mind, as well as the case for IBC and Building Your Warehouse of Wealth, also authored by Nelson Nash. It's important that you pay yourself first. Annual premium to IBC policy should start, if financially possible, at 10% of your gross annual family income when you are young, and steadily increase to 30% of your gross annual family income. You can use policy loan to invest in opportunities that come your way, and they can be in investing and expanding your business or professional practice, real estate, private lending, private equity investments, franchises, or new businesses that generate sustainable cash flows. Use this cash flow to repay your policy loan and reuse these loans to obtain more business that generate increasing cash flow, and on and on. Be sure, that's very important, that you have expertise and experience in the areas you're investing. Otherwise, don't do them. An area of expertise and experience that you have is your own practice. So use the cash flow in your IBC policy, perhaps to increase the amount of business that you do for yourself. Now, you become wealthy when your annual sustainable cash flows exceed your annual expenditure by a substantial margin. Some of you may prefer, nevertheless, not to invest and only take policy loans to take care of emergencies, to assist in paying for your children's college education, and to supplement your retirement income when you slow down. IBC provides you peace of mind and a stress-free life. So regardless you are the person that like to invest or not, IBC is an excellent product to own. Slide 32. Who are we? We're a married couple who started in the financial services industry in the 1990s, specializing in life insurance and financial advisory services. In 2005, we founded our company, Universal Wealth Manager LLC, in Coral Gables, Florida. During the 2008 financial crisis, we came to the conclusion that conventional financial wisdom was based on faulty premises. And to properly serve our clients and protect them from the greed, corruption, and irresponsibility of Wall Street banks and financial institutions, a paradigm shift was in order. After studying in depth the infinite banking concept, we realized that the only way to control our financial future was to control the banking function ourselves. We were trained in the infinite banking concept by Nelson Nash himself, and we are both infinite banking concept authorized practitioners. Our only function since 2008 has been the design of high cash value, dividend-paying whole life insurance policies, or IBC policies. We're experts in the implementation of the IBC concept and in the design, structure, and internal mechanic of whole life policies. As a result, we have been guest speakers at the IBC Practitioners Think Tank Symposium. We have designed thousands of IBC policies for our clients in all 50 states. We answer all your questions accurately and within 24 hours, and we will honor the privilege of servicing your policy for years to come. We provide all these services at no cost to you, since we are compensated by the insurance company we represent. We work virtually and by appointment only. ISIS obtained an MBA with emphasis in financial planning with the highest honor from Barry University in Miami Shore, Florida. Pedro obtained bachelor's, master's, and PhD degrees in engineering and applied mathematics with an MBA with emphasis in strategic and financial planning, all with the highest honors from prestigious Columbia University, New York, New York. Slide 33. Designing infinite banking policies isn't just one of these things we do. It's the only thing we do. This is very important because you have a lot of practitioners that do a lot of different things. For us, infinite banking is the only thing that we do. So that's important. We concentrate all our effort to satisfy your needs. If you are ready to break your paradigm and investigate this further, please visit us at infinitebankingsimplified.com, where we have a lot of blog posts, audios, and videos explaining the infinite banking concept. If you want to email us, you can do that and contact us at infinitebankingsimplified.com. You can call us. It's a toll-free phone at 1-844-443-8422. Against 1-844-443-8422. We have a YouTube channel, as you can see here, www.youtube.com at ISIS and Pedro Palicio 468. Please let us know if you are ready to implement the infinite banking concept with us. Thank you.